Markets pretty much at record highs. What now? I think that's what a lot of investors are trying to figure out.
Yeah, so listen, as we are kind of passing through this halfway mark in 2025, it's a really good time for investors to be reviewing allocations, trimming what's hot, and kind of reinforcing underweight areas to stay aligned with long-term goals. And listen, diversification remains your best defense against uncertainty and your best offense for what's next.
Megan, same question for you. I think a lot of people are trying to figure out, where do I put money to work? We see the S&P set to open up at an all-time high. Industrials are the leading sector there, and also the tech sector hitting another record high as well.
Yeah, well, we do think that we could see some choppiness into the summer. I think there's a decent likelihood that tariffs go up on July 9th or thereabouts, even if there are some countries that are spared. And then we have the uncertainty around the tax bill, and as well as a number of other issues. So I think we've had a really good run off the April 9th bottom. And at this point, we're probably going to churn with a little bit more volatility. But I think investors should stay invested. There is a lot of opportunity, we think, in the tech sector, but also some of the other more beaten up sectors, maybe even parts of healthcare, which has been a part of the market that nobody has really wanted to touch at this point. And our expectation is for the Fed to cut rates, which should lead to a steeper yield curve, which is a good environment for banks as well.
Speaking of healthcare, Tiffany, you're also looking for opportunities in healthcare. How would you play the healthcare trade?
Yes, absolutely. So listen, in that rebalancing, we're definitely recommending overweight U.S. equities. And so really specifically in large caps, they're going to offer you kind of quality. Mid caps, they're going to offer catch-up opportunities. And specifically, healthcare is going to offer you catch-up opportunities too. Healthcare, financials, communication services. And so one idea that we have is the healthcare select sector, SPDR, XLV, really kind of tilted towards these industries. And so it's a broad-based U.S. healthcare ETF. Why it works, it really offers this kind of defense stability. It's trading cheaper, about 17 times forward PE, below the S&P average of 22 times, with room to catch up. And also with recent hiring and earnings stabilization in healthcare, firms are going to add these like tailwinds.
All right. So I do want to ask you about some of the changes at HHS, the new vaccine panel that's been kind of convened by RFK Jr. and some other issues going on in the healthcare sector. I mean, why there? There are other laggards like consumer discretionary. That's getting a tailwind today, at least for Nike. With so many unknowns when it comes to the healthcare sector, why do you think that's the right place to put money?
So that's just one of them. And listen, at the end of the day, we do think that it is stable. People are always going to need care. And so, yes, you kind of bring up some interesting points. And so we've kind of seen a lot of uncertainty out of Washington all this year. But we do think this is an area that really has that offers an opportunity for stability and really to kind of catch up as well.
Megan, I want to come over to you and just talk about the Fed for a second. You're forecasting 75 basis points of cuts this year. At the same time, we're kind of weighing those reports about the potential for a shadow Fed chair. How do you view that when it comes to market risk?
Yeah, I mean, I think there's a lot of noise coming out of Washington as it relates to the Fed chair. We're not as much focused on that. We're really focused on the balance between the Fed's dual mandates. And right now, it looks like inflation is basically at their target, even for all of the angst about what could happen with tariffs. The backwards-looking data is very favorable for rate cuts. And going forward, we think that tariffs will play through as a disinflationary impact, which is to say that prices might go up on certain goods, but we will see consumers who are much more strapped than they were the last time we did this in 2018. Instead of just taking those price increases and continuing to spend, we think that they will offset their spending elsewhere in services. So all told, at the end of the day, you're looking at lower inflation, and importantly, housing prices are coming down. There's some weakness in the housing market, so we think housing inflation will also continue to trend. And that puts the Fed in a position, as we expect the unemployment rate to increase slightly into the end of the year, where the Fed will be able to cut rates. Now, they didn't really leave the door very wide open for July. So we took our expectation for a July cut off the table, pushed it to September. But we do think that once we get to that September meeting, they will start their sort of re-engage in their rate cut cycle.
All right. So again, stocks very close to all-time highs. We're talking about the S&P and the NASDAQ. Tiffany, I want to come back over to you. We were talking about some of those concerns when it comes to the shadow Fed president having an impact on the dollar, moving the dollar lower, and potentially, Ron and Sana said, money could move to gold. When we're talking about opportunities outside of equities, what do you think about gold, cryptocurrency, bonds?
Yeah, so listen, I think that gold is always an option for us, specific commodities in general. When it comes to bonds, and again, we approach everything from a total portfolio perspective. So when we're thinking about bonds, we favor U.S. investment grade bonds kind of over on that fixed income portion of your portfolio over international bonds. And so listen, U.S. rates really remain more attractive and stable than international bonds. Those are kind of carrying more currency and credit rate risk now. And so how we would play this is kind of favor the 7 to 10 year U.S. investment grade kind of bonds for income, for stability, especially as the Fed is expected to ease a little bit later this year.